Good morning. Today's lesson is going to come from Chapter 7. We're going to be working with different ways to value your inventory. And I'm going to teach you how to calculate cost of goods sold and inventory in this chapter. So what I want to do today is I want to work on one of your first homework problems, or I'm going to work on something that's similar to your homework problem, which is problem 7.1b. So if you'll hold on just a minute with me, I'll pull up 7.1b and I'll attempt to talk to you about this. As you can see now on your screen, I have pulled up problem 7-01b. And what they've given you here is some information about some inventory that you have purchased. This inventory are identical units of inventory. And when you're purchasing identical units of inventory, if you purchase those identical units at different times, they might have different costs associated with them. And when that happens, what we're going to have to do is we're going to have to use what we call a cost flow method to be able to identify the amount of the cost of the inventory that you're going to record on your financial statements. So the whole purpose of doing the problem is to identify the cost of the inventory and to identify the cost of the merchandise sold as well as the ending amount of merchandise inventory. We're going to be using the perpetual inventory system to do this. You'll remember from the last chapter when we talked about the perpetual inventory system, we were talking about inventory that would be kept up with on a continuous basis. So we're keeping a continuous record of the amount of the inventory and how much it cost you for that inventory. Now, in this chapter, we're going to learn about three main different ways to put a value on the inventory. And these main methods are called cost flow methods. And the first method that we're going to be talking about is what we call the FIFO method. That's the first in, first out method. And the first in, first out method, what that means is the first units that you purchase are going to be the first units that you sell. Now remember, we're purchasing identical units of inventory and we're purchasing them on different dates. So as you might know, the prices of the inventory could rise during a period of time. And so what we're going to be looking at is we're going to be looking at the price of the inventory or the cost of the inventory, and if it's rising during a period of time, and if we choose to use the FIFO method, which is the first in, first out method, it's going to give us a value for our ending inventory that will be a little bit different than the other methods that we are going to talk about, which will be the LIFO method, which is the last in, first out method, and the weighted average method. Those are the most common methods that management choose from when they choose to value inventory. And what I want you to realize is that this is a method that management can choose. The FIFO method is the first in, first out method. Sometimes management chooses this, because it kind of matches the flow, the physical flow of the inventory. But we're really not talking about the physical flow of inventory, but we are talking about assigning a cost to our inventory. And if management chooses to use the first in, first out method, uh, we will use what is called a perpetual inventory card. And we use this when we're taking perpetual inventory. This cost card is demonstrated in what you're looking at on your screen here. Notice on this cost card, it's going to be for a 3-month period of time. Most likely, I will not demonstrate the entire 3-month period because it just takes too long to get through this entire period. But what I want to do today is I want to demonstrate at least a month's worth of transactions so you'll get a feel about how to do your homework or how to complete your homework. So we're going to be the done company, and we're using the FIFO method, which means the first units that we purchase and are in inventory are going to be the first units that we sell. Notice this card consists of 3 parts. Got a place for our purchases. They've got a place for the cost of merchandise sold. They've also got a place for your ending inventory. This will be the ending inventory, and the ending inventory would be the last count of the quantity and the total cost that we will be recording in this particular section. Notice in each one of the sections, there are 3 different columns that make up the purchases. There's a place for us to record the quantity. There's a place for us to record the unit cost that we're buying this inventory for, and there's a place for us to record the total cost. All 3 of these are related to the purchases of the merchandise inventory. The cost card also has on it a place for cost of merchandise sold. Notice it too is made up of the quantity of units that you've sold, the cost of the units sold, and the total cost. The ending amount of inventory is also made up of a quantity column, a unit cost column, and a total cost column. So what we're going to be doing is we're going to be recording information in for each date that we have some information about the merchandise inventory. So in the first portion of this, what we're going to be looking at is that they had some beginning inventory in April. In the beginning inventory, they had 25 units that cost them $1,200 a piece for a total cost of $30,000. So in the April 3rd transaction, we're not recording a purchase in this transaction because this April 3rd inventory came from last month's ending inventory. So really we had on the last day of March 25 units that are left in our inventory count. So we would start with the 25 units that we have left in our inventory count, and we're going to put a unit cost on those inventory items, which was $1,200. And then what you would do is you would multiply 25 times 1,200, and that would give you 30,000 as your total cost. So again, what I did is I multiplied 25 units times $1,200 a piece, and that gave us $30,000 of total cost of this ending inventory. So our inventory from March really is going to become the beginning inventory for April. So on this first transaction here, this amount, that $30,000 amount, came from last month's inventory, and they got that by multiplying 25 units. That's the count of inventory that they had last month. What it cost them, and the last time they made a purchase, it cost them $1,200 a piece. So we just multiply the two of those to get $30,000. That's what inventory we have to start with. I think what is important is we need to mention also that on our transactions, where you'll see that there's a purchase or a sale, you would be recording journal entries that go with this. They did not give you a journal to work through as far as purchasing transactions, but I do want to review with you what the journal entry would be. So what's happening is, in a perpetual inventory system, we're keeping a record of every time we purchase merchandise. That's going to add to our merchandise inventory account. So in the journal, you learned from last chapter that when we buy merchandise inventory, we would debit the merchandise inventory account, and we will credit the accounts payable, because in this chapter they're assuming all the purchases that you make are going to be on account. The amount of inventory that you purchased is 75 units. The cost of that inventory, if you'll notice, has risen from the last period when we took our account of our ending inventory. The cost was $1,200, and now that cost has gone up to $1,240. What I want you to realize is, in these cost cards, only the cost of the merchandise inventory is going to go into the cost card. And in a perpetual inventory system, we're going to keep a record of every time we make a purchase and every time we make a sale of our merchandise inventory. Because remember, perpetual meant that we're keeping a continuous record, or we're continuously updating our merchandise inventory. So we'll know exactly how much inventory we have on hand, and we'll know how much it cost us throughout this period of time. So getting back to the transaction on April the 8th, the purchase there, when we buy merchandise, we're going to have to record it in this cost card, because this is what we do in a perpetual inventory system. What I'm going to record for the quantity in the purchases column is the amount that I purchased on April the 8th, which was 75 units. So 75 units are going to be entered on the cost card, and the unit cost of those units is going to be the amount that was given to you, which was $1,240. So $1,240 is the amount that they have purchased this merchandise for. Remember, the merchandise that we're recording is identical in its appearance and the way that it looks. So it would be very difficult to distinguish between the units, but we have to keep a record of the units that we're purchasing at the cost, because obviously it costs more than it did during the last period of time. So to find the total cost of the purchases, we're going to multiply the quantity by $1,240. So the quantity is 75 units times $1,240, and that's going to give you $93,000. That was the total amount of the purchase. Our journal entry would be created where we would debit merchandise inventory for $93,000, and we would credit our accounts payable for $93,000. I think it's important to realize that the journal entries would be entered in the journal on the date of April the 8th. We are not seeing that journal, and for whatever reason, Cengage did not want you to record that information in the journal, but in the real world, we would have it in the journal and we would post it to our ledger. But along with the journal, we would need to complete an inventory cost card, which is what we're doing here. This is a cost card that we're completing for the merchandise inventory. And every time we update the merchandise inventory, we're going to put it in this cost card. Now, what I want you to realize here is that the cost of the merchandise inventory that we purchased is different on April the 8th than it is or than it was for the previous period. And so what we have to determine is how much we have in inventory and what the unit cost of our inventory item be. Now notice that in this part, there's a lighter beige amount that we've got here. And so what we want to show in this inventory is that once we have bought some more inventory, we have more to add to our original quantity. So what I'm going to put down here, I'm going to bring down the amount of the merchandise that I had in my beginning inventory first, because we need to show that 25 items of this are already in our merchandise inventory at 30,000. We also need to show on this very same line here that 75 of our units are going to be purchased at $1,240. So we're bringing across what we just purchased here. And the total cost of that is going to be $93,000. So what you can see here is that there are two different layers of inventory now. They have different layers because this was the same type of inventory that we bought, but it has a different cost associated with it than the inventory had previously. So we have two layers of inventory with which to draw from. So on the April 8th transaction, we not only have the beginning layer of inventory that came from the last period, we just copied that down there, then we bring across what we just purchased to the inventory record. Now we're saying we have 25 units at 1,200 units, that was the cost, and we have 75 units at 1,240 with which to draw from when we sell our merchandise inventory. So when we record a purchase, we must record the purchases in the purchases column here. And in the transaction on April the 8th, we recorded our first purchase because we had inventory left over that we haven't sold from a previous period. That too becomes a part of the ending inventory. Now, technically, our ending inventory would consist right now of 100 units of the inventory that we're working with, and the total cost of that ending inventory at April the 8th would be 93,000 plus the 30,000 from the beginning inventory. So the total cost would be 123,000 for our ending inventory. At all times in a perpetual inventory system, we need to know what the ending inventory is costing us. So on April the 8th, our ending inventory cost us an amount of $123,000. That's these two combined. If we were to stop on April the 8th, which we won't do, but if we were to stop here and prepare a balance sheet, our ending inventory will show up on the balance sheet at the cost of 123,000. Right now, we don't know what the cost of merchandise sold is because we haven't had any transactions where we're selling any items in the month of April. But that's about to change on April the 11th. So if we go back up to our problem on April the 11th, we're going to have a transaction that occurred which tells us that we are selling 40 units of the inventory that we have left on hand. Now, I want you to realize in the additional information that they've given you, 2,000 is the selling price of the inventory. It is not the cost. This 2,000 is what they sold the merchandise inventory for. If you multiply 40 units that you sold times $2,000, the selling price of each one of those units you sold, your total sales on April the 11th will be $80,000. That's your total sale. That is not the cost of the merchandise. Remember, in a merchandising inventory system where we're using the perpetual inventory, we want to keep a record of the cost of the inventory that we sold at all times. In the last chapter, they gave us the cost of the merchandise sold. In this chapter, you're going to have to figure the cost of the merchandise sold. So you remember that when we make a sale in the perpetual inventory system, we have to record that sale in the journal as two journal entries. One to record the sale of the merchandise and one to record the cost of the merchandise sold. So in our journal, we're still going to create two journal entries, but in our perpetual inventory cost card, we are just showing the cost of our inventory that we have sold during this period of time. Now, we've sold is 40 units. That's what they told us here. What we have to sell comes from the April 8th transaction. And in a first in, first sold, or first in, first out method, we're going to sell the units that are in the inventory that we had obtained or purchased first. So in the cost of merchandise sold, we're going to show here that we have sold 25 units at $1,200 each. That came from the first layer of our merchandise inventory. If we multiply 25 times 1,200, it will give us 30,000. What that means is that we have sold an entire layer of our merchandise inventory. The layer cost us $1,200 for 25 units. We've sold that entire layer first. Thus, we get the title first units in, or the first units we sell. First in, first out method means the first units that we bought are going to be the first units that we sell. We're not through with the April 11th transaction because we didn't just sell 25 units. We sold 40 units according to our instructions. So in your calculator, if you are selling 40 units and you have just accounted for 25 of those units, you sold that entire layer, I'm going to deduct 25 units from my 40 units, and what it'll leave me with is 15 units. That 15 units has to be recorded in the cost card. I did not sell just 25 units. I sold a total of 40 units. 25 of those came from the first purchase. The other 15 are going to come from this second purchase of $1,240. So what I have to do is I have to multiply this 15 units by the 1240 to get the total cost of those units. So if I multiply 15 times 1240, it's going to give me an amount of 18,600. And that is the amount that I would enter in my cost card. Remember, this is a cost card for the inventory that we are buying. Because the inventory is identical in nature to units, we're having to keep up with the separate unit cost of those because we have entered a time where the prices of the inventory are rising. So what has happened here is we've sold 40 units all total. 25 of the units had to come from the first units that we purchased because the method that we are using is first in, first out. First units in are going to be the first ones that we sold. We sold this entire layer, so we're drawing 15 units from the 75 units that we had on hand at April the 8th. So what we have left here is the difference between 75 units and 15 units. So I'm going to put 75 units in my calculator. I'm going to subtract 15 units from that. What we have remaining in inventory is 60 units. that cost us $1,240 each. And if we multiply the 1240 times the 60, multiply 60 units that you have left over times 1240, that will give you 74,400. And what this tells us on April the 11th is that we've sold 40 units all total. The cost of the merchandise sold is the total of 30,000 plus 18,600. So the cost of the merchandise sold for the April 11th transaction is 48,600. That cost of merchandise sold is the amount that you would use for your journal entry. Remember, your sales have two transactions. The first transaction would have recorded the sales in units times the selling price. The sales in units times the selling price was $80,000. In the journal, we would have a debit to our accounts receivable for $80,000, credit to our sales for $80,000, and we would also have to record a journal entry where we would have debited the cost of merchandise sold for the total amount that was sold, the two of these together, which is 48,600. Our cost of merchandise sold would be debited for 48,600, and our merchandise inventory would be credited for 48,600. And if you looked at that, those journal entries, after they had been posted to the ledger, what you'll have as a remaining amount in your merchandise inventory account is a cost of 74,400. That is your ending inventory cost, because at all times we are responsible for keeping a record of the amount of our merchandise inventory constantly in a perpetual inventory system. So what we know is that on April the 11th, we have 60 units left in our merchandise inventory that cost us $1,240. The amount of the ending inventory is 74,400. In the next transaction, which also happened on April the 30th, we had another sale. We sold 30 units at a selling price of $2,000. Notice the selling price has not changed during this period of time. So 30 times 2,000 is $60,000. That's your total sales on the April 30th transaction. We would debit accounts receivable in our journal for $60,000, and we would credit our sales for $60,000. We would also need to update our inventory because we have sold 30 more units. So we're going to go to our cost card and we're going to enter in 30 units that we've sold. We've sold 30 units, and the only ones that we had to draw from were from this layer of inventory that we had left over on April the 11th. The cost of that inventory was $12.40. So $12.40 goes into my unit cost card, and I would multiply 30 times $12.40, and that will give me the amount 30 times $12.40 will give me the amount that I sold on that particular date. The amount is $37,200. So this amount right here, the $37,200, is the cost of the merchandise that was sold on April the 30th. This is the cost of merchandise sold. So you'll remember in your journal, we debit the cost of merchandise sold for $37,200, and we would credit our merchandise inventory of $37,200. What we have remaining in our inventory is the difference between our units sold and what we had left over from the last date, which was April the 11th. So 60 minus 30 is 30 units that we have left over. We're going to bring down the same unit cost of $12.40 because this is the layer that we're drawing from. Our ending inventory has a cost per unit of $12.40. Then we're going to multiply 30 times $12.40, and that will give you $37,200. That's the amount of our ending inventory on April the 30th. And so normally in class, I just do the first transaction with you. But I'm going to go ahead and continue on to see how far I can get today with this, because you've got to finish this transaction up in order to be able to do the second part of the transactions and the third part of the transactions. And so you would just keep on going through this particular problem. So I've got a few more minutes left, so I'm going to take a little bit more time, and I'm going to go on and show you what would happen in the month of May. In the month of May, we have another purchase. Notice this time it's a purchase, so we're buying merchandise. In our journal, we're going to record a debit to our merchandise inventory and a credit to our accounts payable for the cost of the merchandise that we purchased. We're buying 60 units at a price of $12.60. Notice that price has gone up from the last purchase, so we're in a period of rising prices. Our prices are continuously increasing. It looks like we're in a period of rising prices. Remember, these units that we are looking at are merchandise inventory that is identical in nature. And because our prices are continuously increasing, it makes it a little bit difficult for us to keep a record of exactly what the cost of our merchandise inventory is. So that's why we have to show the inventory cost flow method that we're using. Remember, we're using the FIFO method in this problem, which means the first units that we buy are going to be the first units that we are going to sell. In this case, we're not selling anything at all. We're buying the inventory. So what I want to do is multiply 60 times 1260, and that will give you 75,600. That is the cost of your merchandise that you have purchased on May the 8th. So we'll want to record 60 units that we bought on the 8th of May. We purchased those units at $12.60 time. Multiply 60 times 1260, and that will give you 75,600. And this is what goes in the purchases column. Notice we're not doing anything in the cost of merchandise sold because this transaction had to do with the purchase. We were not selling any inventory. Because we're using the first in, first out method, we have to bring down the last layer of inventory that we had from the previous month, which was 30 units that we had at 1240, which is 37,200. We're going to bring across 60 units at the purchase price, which was $12.60, and we bought it at a price of $75,600. So on the May 8th transaction, we have two layers of inventory. One that was brought forward from April the 30th, which was your ending inventory that you just brought down on this first part of the May 8th transaction. Then you recorded what you purchased, and that went in as a separate layer. Right now, the ending inventory consists of both of these layers. We would add the two of these together if we were doing a balance sheet at this time. We're not doing a balance sheet at this time because we're not through with the end of this period, which is going to be for 3 months that they're doing these transactions for. So we're just going to continue on. On the May 10th transaction, you can see here that we had a sale. We sold 50 units this time, and it cost us, no, I'm sorry, this is not cost. We sold them for $2,000 a piece. This is the selling price of the merchandise inventory. In other words, this 2,000 is the marked up price because we'll want to make a profit off of our sale. So 2,000 is the selling price, and if you multiply 50,000 times 2,000, it will give you 100,000, which is the selling price of this merchandise inventory. We would record the sale amount in the journal. That would go in the general journal, and that journal would debit accounts receivable and credit your sales for $100,000. Because we're using the perpetual system, every time you make a sale, you create two journal entries, one to record the sale that we just talked about, and one to update the merchandise inventory. So before we can update the merchandise inventory, we have to complete our inventory record, and that is the inventory cost card that we're going to be working with. Now, what you have to remember is how much you sold. And on May the 10th, we sold 50 units of merchandise inventory. Notice that 50 units, because we're using the first in, first out method, we're going to liquidate the entire first layer that we had of this merchandise inventory. So our cost of merchandise sold is going to consist of two parts. Part of this came from the cost of the inventory that we brought down from April the 30th. We had 30 units there that cost us $1,240, which is $37,200. And then because we sold 50 units, we've accounted for 30 of those. We have 20 left to account for, and those would have cost us, it would come from the last purchase, which was on May the 8th, at $1,260. So you will multiply 20 units times 1260, and that will give you 25,200. Now what this means is this entire layer has been sold, so it's no longer there. We've sold 20 of the 60, so we have 40 left in ending inventory that would have cost us $1,260. And we would multiply 40 times 1260, and that will give you 50,400. This is the amount that we have left over in our ending inventory. And so I want to stop right here, and hopefully this has given you enough information about how to fill out a cost card using the FIFO method, which is the first in, first out method. And next time that we meet, we will complete, or I'll show you a completed cost card, and then we will do the remaining parts of this problem. We will also hopefully get into the next method, which is the LIFO method, and we'll talk about doing the LIFO method, which is what you're going to have to do in problem 7-02B. So hopefully you understood what we've done so far. If you have any questions, shoot me an email or you can ask now. I don't hear any questions, so I'm going to stop here today. Thank you for joining me, and we will see you again on Wednesday.